Okay, let's get into the nitty-gritty, the regulatory thickets. Just describe for me, David, just put a little bit more flesh on the bones of the answer you gave earlier in terms of the complexity, the different layers of regulation that we've had here in Europe, Eurozone and broader European Union since the Lehman collapse, and how that compares to the US.
So it's been pretty funny because so the first thing is that after the 2008 crisis, we had a first reaction which was called Basel 2.5. So Basel 2.5, it's a set of regulation which addresses the nasty transaction done by investment banks, like securitization, for example, which is a bad word since then. So all the idea of Basel 2.5 has been to increase the capital charges of those activity, complex trading, securitization, and these kind of things. This has been implemented quite equally in Europe and in the US just after the Lehman crisis. Then, starting on September 2010, we've had the final draft of Basel III. So Basel III addresses the liability part of the bank. How do I fund my activities? And two set of things have been decided. First, of course, to increase the regulatory capital of banks. We come from a system where under Basel II, banks used to operate with a minimum of 2% of equity. In Basel III, a minimum of 4.5, and if you add the different layers, most national champions will operate with a minimum of 9%. So this is a good news. On the capital, something else has been done, which is pretty interesting for the subordinated debt strategy, but we'll come back to that later. It's simply that one of the outcomes of the crisis was for the regulator to see that during the crisis, some sub-debt, which were supposed to absorb losses or to skip coupon, hadn't done anything. You still find bonds that were paying coupons. You still find bonds that didn't absorb anything. So it was quite messy, and the regulator has decided to change that. But we'll come back on that later. The second important topic of Basel III was a change in the senior funding. And three ratios have been introduced to banks. So the first is a liquidity ratio. So it's the idea that you will have to hold a certain amount of liquid securities in order to face with your 30 days commitment. So you will tell me this is incredible that we wait until 2010 to put this in place. This was existing before. What has changed is what you can put in this ratio, what you consider as a liquid security. Before 2008, I mean, an unrated securitization was roughly eligible, depending on the country. Now, uniformization has been done, and it's much more strict what you can include in this liquidity bucket. Second thing, the second ratio, which is important, is what we call the net stable funding ratio. So this ratio is key to limit maturity transforming models. So what is maturity transforming models? Jérôme was talking about Germany a bit earlier. In Germany, most of the German banking system was relying on the maturity transforming systems. That is to say, extending long-term loans mainly to the public sector at margins which were pretty slow.
Short-term funds.
Yeah.
Because they had to compete with the state subsidized
Landesbank.
Exactly. Exactly.
That's how DEPFA basically went bust. Huh?
Hayek would approve of that analysis.
And so they used to fund themselves on a very short period at Euribor minus 60. Yeah. And of course, the first thing that destroyed the 2008 crisis were the German banks, due to the fact that the first aspect of the 2008 crisis was a liquidity crisis. Yeah. So all these banks which were relying on short-term funding,
the interbank market
exactly
dried up.
Exactly. Yeah. So now the net stable funding ratio is a ratio which is meant to change that, and it's the idea that when you make a loan, when you extend a loan on a 5-year term, you have to have the funding on a 5-year term, to put things simple. Then the last ratio is the leverage ratio. So the leverage ratio is a ratio which is meant to limit the increase of balance sheets in banks in Europe. And so this is a very interesting ratio because it has been pretty controversial.
It's gone, roughly speaking, it's gone sort of 25 at the end of the 19th century down to 2.
Yeah.
Just before Lehman, and now we're flirting with 3, maybe 3 and a bit.
Exactly.
Is that an adequate response?
It's very difficult to say because it depends on the importance and the use of banks in their context. For example, in the US, the economy is mainly financed by anything but banks. They account for 20% in the funding of the economy. So the leverage ratio is not of a systemic importance as it is the case in Europe, where 80% of the economy is funded by banks.
And also, just to interject, I don't want to ruin your train of thought, but the American banking sector, for all the razzmatazz and cultural predominance of Wall Street, is only about 1 times annual GDP. Yeah. In this country, for instance, our banking sector is 5 times.
Yeah, the average in Europe is around 4.
In Scotland, interestingly, if Scotland leaves, this really is an aside on an aside. If Scotland leaves the UK, Scotland's banking sector will be 12 times its GDP.
So it's Luxembourg in the north,
like, or Iceland with only slightly better weather.
But if I may,
so a 2% leverage ratio was clearly cataclysmic, and now we're going to 3%. I get it, and that certainly chimes with my observations as an outsider to this sector, that Eurozone, pan-European banking regulation does seem to have been more stringent than in the US. Even though the US banks have probably done a better job of cleaning up their balance sheets.
Well, they don't have a balance sheet, so it's easier to clean.
They're a figment of everybody's
they
imagination.
have very small balance sheet. Yeah.
Just before we move on to how effective you think Basel III will be, as close observers of this sector, what do you think of Dodd-Frank? I mean, the caricature is that it's just been torn to pieces by a rapacious banking lobby on Capitol Hill. Do you think it's going to have any effectiveness at all in terms of safeguarding what is a smaller US banking sector, but one which is still systemically important, not only to the US but to the world?
So if we talk about the Dodd-Frank Act specifically, the first thing to say is that although the law has been passed, it is still not applicable, and it's still in the negotiation details, and it's not before 2019, something like that. So we're very far from having this kind of law applicable in the US, and it's very interesting, and it's very symptomatic of the way the US handle regulation. In general, there's a big difference between the US and Europe from that standpoint. Europe really has pushed the bank into the regulation. US still operates under Basel II, and the constraints remain pretty light. Although we can discuss about that. The leverage ratio they have, we don't have. But in general, rules appear to be stricter. However, they seem to be. This is really the case only on the surface. When you look into detail, it's very different. One very good example, for example, is the accounting, the discrepancies between the accounting treatment of derivatives, which really are of utmost importance in the calculation of the leverage ratio. Under US GAAP, I think we have a very interesting slide on that. Under US GAAP, you are authorized to net your derivative positions. Okay, so what you will post on your balance sheet is the net position. Okay, under IFRS, this is an exception. So all the derivatives in European banks are on their balance sheet.
Sure.
Okay, so you've heard that the European banks were much more leveraged than the US bank. Okay, now if you retreat the derivative position, you will end up to the conclusion that they are quite comparable. So if you see in this graph, what you see in blue is the leverage ratio of US bank under US GAAP. If you retreat them, if you re-include the derivatives based on the IFRS rule, you will come up with these levels, which are quite comparable with European banks that you see on the left.
Didn't I read that in Basel last month there were tweaks made to the treatment of netting off of derivatives and the treatment of other off-balance sheet vehicles in the computation of the leverage ratio under Basel III?
Exactly, because this has really drove mad many finance directors. For example, and many head of banks. I remember Joseph Ackermann. At the time, he was heading Deutsche Bank in 2009. He was really mad about that because, of course, Deutsche Bank had a huge balance sheet, 3 trillion. And he decided at one quarterly release to show the balance sheet of Deutsche in US GAAP and in IFRS. And the difference was roughly $1 trillion.
Pretty significant.
Yeah.